Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. We are bringing the VRIC to you each and every week with our series of expert online panels, and I'm very excited for the one we have lined up for you today. We've got Andy Schectman, President and CEO of Miles Franklin Precious Metals, as well as Alasdair Macleod, the founder and publisher of Macleod Finance, available at alasdairmacleod.substack.com. Gentlemen, it's great to have you both on the program.
Thank you for having me.
Here.
I want to kick things off by discussing the GENIUS Act because this is something that is causing me a lot of consternation, and I think a lot of other people as well. I'm going to start off by reading what it aims to do, which is establish a federal framework for regulating payment stablecoins, a type of digital asset designed to maintain a stable value relative to fiat currency. The act aims to create a clear regulatory environment for stablecoins, impacting issuers, custodians, and banks. So firstly, why do you think this act was created and signed into law? And secondly, is this a positive or negative development for financial regulation in the United States? Andy, I'll start with you.
Look, maybe I'm a cynic or a skeptic, but to me, Jesse, this was created to find synthetic demand for the U.S. Treasury, which is lacking organic demand. And we've covered ad nauseum, all of us in this industry, for the last year or two, starting with the weaponization of the Treasury market, obviously against Russia, or the fiscal irresponsibility, the brain dead monetary policy, along with the issue of trust. And you go back over the last 4 years and look at a country that had lost its way with election interference, or at least the perception of it, the perception of a two-tiered system of justice, the immigration issue, the lawlessness, the wokeness, the massive amount of indebtedness. We get to this administration, which certainly in my mind is far better, at least from a standpoint of reinstilling our culture, but hasn't done much to reinstill confidence in trust. To me, what this stablecoin bill does, and it's interesting, you know, the title of my show that you've both been on is Little by Little, where things happen little by little by little and bang all at once. It speaks to logarithmic decay. Think of just a year or two ago, the concept of stablecoin. I mean, you never heard of it. I mean, yeah, some did. You heard of it, but it wasn't like bang right in your face like it is right now. When all of these are backed by U.S. Treasuries, what you are seeing in essence is a massive synthetic demand for U.S. Treasuries. And maybe, again, I'm a cynic, but I don't quite understand how you actually can call a stable coin backed by a mountain of increasing indebtedness stable. But for me, it's not what people are saying it is based upon what they claim it to be. To me, it's about a way to fund the front end of the Treasury market in a environment where it's probably losing a little bit more demand than would otherwise be operational to continue to fund our irresponsible, and I guess you could say borderline. We're more we're spending addicts, and to spend or to help fund the addiction of constant spending, enter the stablecoin bill. That's kind of my take on it.
And so stable coins are supposedly backed one-to-one. They're supposed to maintain the same dollar value as the US dollar, and they're backed by long-term treasuries. Is that how it works?
Short-term
treasuries.
Yes, short-term treasuries. And I've been talking about a theory that I have on the back end of the market, which maybe we'll have time to get into. The back end of the Treasury market, I believe, Judy Shelton, will be pegged gold. Ultimately, so you can have zero coupon, zero interest rates, redeemability in gold. And so that would be how you reshore manufacturing, by revaluing the price of gold, devaluing the hell out of the dollar, pegging it to redeemability in the 10, 30, and as Judy says, starting with 50-year Treasury, in order to have zero borrowing costs and a devalued dollar to bring back manufacturing. The front end of the curve will be controlled by the issuance, continual issuance. And it's not just the banks. You'll see corporations all over the place start issuing like American Express, will start issuing stable coins, and those will all be pegged to and legislated by the government, pegged to U.S. Treasuries. So yes, it's a funding mechanism for the Treasury market, which is losing demand based upon lack of trust in a system that is all about trust. The full faith and credit of this country, I think both the faith and the credit could be called into question, certainly by our long-term creditors, who I think are looking maybe in a different direction all of a sudden.
Well, we're definitely going to discuss the potential for gold revaluation a little bit later. Alasdair, your thoughts on the GENIUS Act and its potential implications for the U.S. and global economy?
Yeah, I mean, I don't think it has any, if you like, hidden implications or anything like that. The fact of the matter is that stablecoins are extremely profitable as far as the banks are concerned, because, as Andy points out, what do you pay on? What does the bank pay on a stablecoin? Zero interest. What do they receive on the, as it crosses the balance sheet into the asset side? They receive T-bills, probably no longer than, I mean, it shouldn't be longer than about 28 days, because it's meant to be cash against cash. So 28 days gives you what at the moment, 4.3%, something like that. I mean, what's not to like? And I think this probably came about very much with the agreement, if not maybe a little bit of background lobbying by US banks, who kind of like this stuff and at the moment are basically frightened of risk. I mean, I'm sure their lending officers are sort of seeing stuff coming in that really worries them about extending credit to business and so on and so forth. This, if you like, is a reverse deal in the sense that it's banks issuing stable coins. They're effectively acting rather like the old-fashioned deposit banks, which have always eventually failed or gone into credit creation. And of course, as far as the US Treasury is concerned, I think, as Andy points out, anything to help buying of US government debt. And so it fits in very, very well with that. Now, having said that, I think the idea that stablecoins will expand more rapidly than the crypto market, I think, are ill-founded. I don't see that at all. I also think the real danger in this is that the crypto market is basically a scam. I mean, we love the ideas of blockchains and the possibilities and all the rest of it, but when you see who actually owns Bitcoin, who actually is dealing in it, who actually is ramping it, which is really what's been happening, I mean, it's full of crooks basically and Ponzi scheme merchants. So, I think once the credit bubble bursts, which again I'm sure is a topic which we'll get into, then leading the pop bang, the implosion is going to be cryptocurrencies. And then, of course, we ask ourselves about, was this GENIUS Act such a good thing? Is it ever going to produce anything, et cetera, et cetera? So that would be my take on it. I think the banks wanted it because they see this as being an extremely profitable thing. I don't think it's the big banks. I think it's, the sort of, a few tiers down maybe. I think as far as the regulators are concerned, they just want to bring this into their tent so they can have some control over it. Other than that, I think nothing to see, move along.
The copper market, of course, is the biggest metal market on the planet, 200 to 300 billion globally of metal traded. Following majors around and picking up projects that they jettison can lead to great success in this business. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
All right. Well, I want to talk about an article you wrote recently on your Substack. It was called Bear Squeezes in Precious Metals. You wrote, lack of physical liquidity is putting a bear squeeze on gold, silver, and platinum group metal derivatives. After a bullish consolidation, gold, silver, and PGMs are set to resume rising. So walk us through what you're seeing there. And then, Andy, I'd also like to get your thoughts after as well.
Yeah, okay. Well, the basic background is it's not so much gold and silver rising. Well, silver maybe, but it's not so much gold rising as the dollar and fiat currencies losing purchasing power at an accelerated rate. So that's the background to it. So the idea that this sort of gold bull market is a bull market on is actually misunderstanding the whole thing. What we're looking at is a bear market in dollars. And as we go into recession, I mean, we've already been in recession for about the last 2 years. I mean, if you take the budget deficit out of GDP, you can see pretty much how much GDP is coming out of the private sector. And the answer is a negative figure. So on that basis, you can see that there is absolutely no doubt that dollar is going down, and this will be reflected in far higher gold prices over time. You look at the technical chart, and I mean, it just confirms that, etc. So what actually we're talking about? We're talking about the death of the fiat currency system. That is dying. It's as simple as that. It's been running for 54 years. It's now coming to an end. And it's coming to an end because it's just created so much unproductive debt. That's all our economies, from governments and into private sectors, are just overloaded with this debt. They can go no further. We are sinking in a sea of debt. That is the other side of the credit bubble. For every debt, there is a credit. The credit bubble is it's the biggest one we've seen in history. It's far bigger than 1929. So we have this problem that when you get the death of the of fiat currencies, other things die with it. And obviously, one of the things that dies with it are the stupendously large derivative markets, because we're moving into a situation where, I mean, the idea of derivatives is you use them to hedge risk. But we now have a problem that the participants in that market are themselves greater in terms of risk than the risks which we use derivatives to hedge. I mean, we just don't want these counterparties. And that is an increasing problem. And we can see this with, in the case of gold, what happened earlier this year? Well, the Bank of England suddenly was shipping gold out, or, people who were storing gold in the Bank of England were shipping it out. There's a queue around the block to try and get it out. And the Bank of England was saying, it's going to take 6 weeks, whatever. The fact of the matter is that the Bank of England does store some gold for commercial entities, but the vast majority of the gold it stores is actually on behalf of central banks. And those central banks defray the cost of storage by leasing it. Now, under a lease contract, ownership passes, under the terms of the lease, entirely to the other party. So if you've leased gold, which is sitting in the Bank of England, and the Bank of England has long been saying, well, don't worry, this is just a book entry. It just goes across to Charlie, who wants to borrow your gold. And at the end of next year or whenever the lease expires, we'll do a contra entry, and so it won't leave the vault. But it's left the vault. What this is doing is it's making central banks very wary of leasing gold. I mean, it's just quite obviously, it's the most stupid thing a central bank can now do. What do? They withdraw from the leasing market. And as those leases fall due, they're not being renewed. And I suspect in quite a lot of the cases, the gold is not being returned because it just simply is nowhere to be found. So under these circumstances, what we have is the shortage of physical beginning to impact on liquidity in the derivative markets. And we can see this on COMEX with open interest in the gold contract. Despite gold rising into new high ground and, doubling in whatever in the last year or 18 months, you'd think open interest would be 600,000 contracts or something. No, it's sort of only just above the oversold levels. I mean, basically, the squeeze has been on the system. And the same is true in silver. Particularly in the last week or two, we've seen open interest in the silver contract fall while the price shoots up. What's that if it's not a bear squeeze? We've got it in platinum group metals. It turns out that both America and China have been stockpiling platinum. How much is there left in the market? Zippo, nothing. There's nothing in London at all. no liquidity. I mean, obviously, there are people who own platinum, probably commercial entities who store it in London vaults. But this isn't liquidity available to the the people who make sort of deal forward contracts and all the rest of it. So this is what's happening. And the other thing I've discovered is that if you look at the values of base metals, they have been left way behind with all the dilution of purchasing power of fiat currencies. If you measure it in gold, a basket of these, and it was a basket that was actually put together by the IMF some time ago. That basket, I mean, from the year 1900, when you had, you could sort of index it against gold at that stage, the 1900 price today measured in gold is in the region of 20% of, I mean, the value is fallen to 20% of where it was measured in gold. In other words, there's a huge, great catch-up in basic metal prices. What's that going to do to the derivative markets? Oil, I think, is another one. Oil is incredibly volatile, certainly in the front end, but I have no doubt that energy is going to become increasingly important as we approach the winter. We've got food problems and all the rest of it. I mean, the food prices are rising. This is something which isn't much talked about, but here we are in the summer months in the Northern Hemisphere, food prices should be falling because we've got harvests and things like that, but they're not, they're going up. So, the whole of construction of trying to create artificial supply and suppress prices, which was really something that was invented in the 80s after Volcker raised interest rates to kill the gold market. That is now unwinding. The whole of fiat currency system is unwinding. And that is the fundamental fact behind what's going on in derivative markets.
Fantastic summary. Andy, your thoughts?
Kind of hard to follow up at that one, but I'll give it a shot. What we are seeing, I will echo substantially from what Alasdair said, but we're seeing a draining of the world's exchanges, at least everywhere else besides the COMEX, which is getting filled. But there's some interesting developments. Last week, there's a man named Bruce Ikemizu, Ikemizu, and he was formerly head of Chinese bank ICBC Tokyo's precious metals desk, and now head of the Japan Bullion Market Association, kind of like the COMEX in Japan. He says the market may already be broken. He says London, to what Alasdair was saying, appears to have virtually no physical platinum available for delivery. He says it seems that there really is no platinum in local London, Zurich, yet continues trading nearly 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery. Something is about to break, he says. But this is something that we're seeing all over the place. It's not just in London. We're seeing some really crazy, interesting things happen here in the United States as well. And I'll give you an example. If we just take a look, for example, at the first 3 days of the August contract. I've been screaming that we are watching these deliveries since November come in since the election that are ridiculous, that they're so far outside of what is normal. The people need to take notice that the people that are doing this are incredibly sophisticated and well-heeled. You do not see deliveries coming into the COMEX the way that we have been month over month over month over month over month since November and not take notice. Yet you don't hear a damn word by the mainstream. Okay, so the important things are ignored by the mainstream and are covered by guys like you and Alasdair and myself and others in this industry who spend copious amount of time trying to dig. The fact that we aren't hearing anything about this is crazy. We've become a net importer of gold since November. That's something that we haven't ever been in my 35-year career. Never, maybe a month here and a month there. Every single month, we're seeing massive amounts of gold and silver being brought into the United States. In the first 3 days of the August contract, we saw over 2 million ounces of gold post for delivery, over 20,100 contracts. Now, I used to say that less than 1% of contracts stood for delivery. During my career, that would be a truism. No one stood for delivery. These contracts were rolled over. These contracts were cash settled. It would be a way for producers or even a company like myself to hedge exposure. If I have 2,000 ounces or 5,000 ounces of gold in my warehouse, I will sell 5,000 on COMEX. If the price goes down on the 5,000 ounces of gold by $100, I'm down $500,000. But what I sold short on COMEX goes up commensurate. So it allows me to be market balanced, market neutral. I don't have any intention whatsoever of taking delivery of those contracts, but that is exactly what we are seeing. And to give you an idea, remember I said less than 1%, just within the first 3 days of the August contract so far, of the 20,126 contracts that were posted, 100% of those contracts, all of them, stood for delivery. That's $7 billion worth of gold that stood for delivery. Now, this is what we've been seeing nonstop. What is also interesting is that the majority of that gold, goodbye, left the exchange. Now, a lot of times people say, well, you know, the stuff standing for delivery isn't leaving the exchange. It is leaving the exchange. And you ask yourself, who the hell's doing this? Who's got that kind of bread, that kind of liquidity? But we've been seeing this every single month, month over month over month over month over month. 4 billion this month, 8 billion this month. Now, there was an interesting chart that I saw, and I want to give credit where credit is due. I don't know who this is, but it's PM, Precious Metals Bug, on Twitter. And he says, I looked for the totals for the COMEX daily silver stock reports for the last few days. And this would have been from August 1st. It's August 1st, and then you had a weekend, the 4th, the 5th, the 6th, and the 7th, okay? 1, 2, 3, 4, 5 trading days. In 5 trading days, we saw 1.721192, 1,721,192 ounce, 1,721,192 ounces of silver that was received into COMEX, right? So you're talking a lot of money. Over 1.7 million ounces of silver came in to the COMEX. But what left for delivery, what was withdrawn out of the COMEX in that same period of time, 1,890,316 ounces. More silver left than came in. Now ask yourself this question. Where the hell is 1.9 million ounces of silver going to be stored, if not in the COMEX vaults? Where's it going? Who's taking possession of it? And so when you talk about the potential of squeeze, you look in London, as Alasdair said, they told us it's T plus 8 weeks. It's a T plus 1 settlement market, meaning T is trade day plus 1 is settlement. The third day, those bars better damn well be moving my direction, because I own a company like I manufacture jewelry all over the world. Well, what do you mean my bars are 8 weeks delayed? Well, you know, there's a shortage of manpower and trucks that the Bank of England tells us. Oh, I see. So the Bank of England doesn't have enough trucks to load my bars, but I've had this contract and I'm expecting the gold and silver because I have jewelry to make all around the world, but I got to wait 8 weeks. Well, that's what we're being told. Same thing here is being said. The head of the Japanese Metals Association is saying there is no platinum, yet they're trading 3 million ounces a day. If you listen to David Jensen, who's one of the great minds, in my mind, on what's going on in the LBMA, he will tell you that they trade, that there's a 155 million ounce float of silver, the LBMA. That's the amount of silver backing the bars, right? But he says that they're trading 190 million ounces over that amount every day. But here's the interesting thing. He also says that those numbers are 10 times understated, the amount of trades, because they only post the final settlement numbers. So he's saying they trade upwards ends of 1.9 billion ounces of silver per day off of a 155 million ounce float, which is 3.5 times the annual global mine supply and, 15 times the float. You see a problem here when people stand for delivery? This is the squeeze. It's in silver, it's in platinum. You're seeing it in massive gold deliveries. Something very, very, very different happening, where physical demand, and again, go back to trust or lack of trust, physical demand and repatriation out of the Bank of England, the New York Fed, and now the COMEX and the LBMA is something that is highly unusual. That is the whipped cream on top of the unusual sundae, that all of the deliveries, the majority of them in the case of silver in the first 5 days, more silver left than was delivered. And to see contracts post, and as much as 100% of those contracts stand for delivery when the norm was 1% or less, this is the stuff that people need to pay attention to. Price is the ultimate tool of misdirection. The effort it takes, the sophistication it takes, the wealth it takes, the understanding it takes to not only stand for delivery in this amount, but to move it out. And where the hell are you going to put it? You're talking several semi-trucks worth of silver. Where is it going? Who's taking possession of it? Could it be the Treasury Department under the guise of the Exchange Stabilization Fund? So they'll say it's national security so they can keep their mouth shut and not tell Congress? Or is it Warren Buffett? Is it who the hell is it? Is it Elon Musk securing it for, his production? I don't know, but I will say that a short squeeze is setting up in massive proportions based upon the deliveries and the exodus out of the exchanges, and this ecosystem that all of the traders have gotten used to, where stuff flows back and forth between the U.S. and London and Switzerland. It's broken, and it seems to be accelerating little by little by little. Then you wake up one morning, bang! There's no one stupid enough to sell at these prices. And then you start to see prices move eastward. You'll see prices that will have real material impact in Shanghai, in Dubai, in St. Petersburg, in Moscow, the new BRICS exchange. The people that are accumulating and producing more than we are and understand it, I believe, will ultimately compete with the West because of this crap for real price setting, for real price discovery, because the distortions have been created in the West. Shame on us. Shame on the folks at the Bank of England for doing this. And it's now being used against us in this manner where, yeah, go ahead. We'll take your stupid purse, but you know what? We're going to stand for delivery and we're going to pull it out of your exchanges and it ain't ever coming back. So I think Alasdair's spot on. When you talk about a short squeeze coming, you can see it. It's just a matter of how long they're able to keep the ball up in the air. And I would never count out the ability of these Western banks to keep it up longer than we expect. But ultimately, mathematics will have its way and logic will prevail. So these numbers to me are more important than anything. The delivery numbers, that is.
Yeah, some great data. Appreciate both of your perspectives on that. I do want to move on to the potential for gold revaluation because interestingly, the Federal Reserve recently published a note called Official Reserve Revaluation, the International Experience. Here's a quote about it from Forbes. It outlines how 5 countries used gains on their official gold holdings to raise funds. It does not propose the U.S. do the same, but it explains the steps involved and what to expect if it happens. Do you think the release of this note could be a prelude to the U.S. potentially revaluing its gold reserves? Is that even a realistic proposition? And what would the implications be? Alasdair, I'll go to you first on this one.
No, I don't think. I think all this talk about gold revaluation is premature. I really do. Apart from anything else, we all know, the world's biggest open secret is that the U.S. Treasury doesn't exactly have 8,130 odd tons, which it states it has. How much it has, I really don't know. Before any gold standard could be contemplated, there would have to be an audit, a proper audit, an independent audit of US gold reserves. I don't see that happening. The other thing is that the system, that both the Treasury and also the Fed don't understand basic economics. They don't understand why money, corporeal money in the form of gold, is so important. It anchors the value of credit. They don't understand this at all. They're macroeconomists. They're not classical economists who, over centuries, work things out. That was all discarded by Keynes in 1936 in favor of governments manipulating our lives. So we're talking about climbing down completely from that sort of situation where governments actually have an awful lot of discretion as to what they can do with their currencies. I just don't see it. I mean, it's people who think that this is going to happen, I think, are people who fundamentally believe that things are under control of the government and government can just turn around and do things slightly differently. That's not the case. They really cannot. I mean, in this country, we've got a highly socialist government, and we saw not so long ago the Chancellor of the Exchequer, our finance minister, sobbing in Parliament over her predicament. And this is not a personal matter, which was sort of meant to be part of the story. I mean, the fact of the matter is that her Treasury officials will have told her that her first budget was an absolute disaster. They probably advised her against doing it, but as a union member, as a far left socialist, all this sort of schoolboy socialism type stuff, which these people have fed on, and haven't been able. I mean, they haven't been able to sort of pursue these fancies. She pursued these fancies and basically screwed everything up. So what happens? You find that the cabinet then has to try and come up with welfare cuts, and surprise, surprise, the parliamentary party, whose members are all elected to protect welfare payments and enhance them, refuse to go along with it. So the whole thing is just a complete and utter mess. And the idea that with that sort of commitment to welfare states, that we can turn round on a dime and introduce new gold standards, forget it. It's not going to happen. Crisis first, solution second. We have to really have a major, major crisis, collapsing the currencies before everybody's minds are focused enough to accept a solution. That solution would be a lot more radical than most people think.
And Andy, your thoughts on the potential for gold revaluation in the United States and what the implications of such a move could be?
Well, I want to first start by saying I will often cite Alasdair's work. Often credit him when I'm on with Dunnigan and others that he's the smartest guy in the industry. So I say this with respect, and I'm going to take an opposite viewpoint on this because I've been trying to think how we get out of this sticky wicket. I'll just cite two other things real quick before I jump into that. Michael Hartnett, analyst at Bank of America, came out just the other day and said central banks will be forced to revalue gold reserves to reduce domestic debt burden. Very positive for gold. And then Francisco Blanch, Bank of America Securities, says gold revaluation bullish for gold, showing it's no longer a barbarous relic but a key asset for central banks. Now even the biggest central bank of them all is taking a renewed interest in gold. He said that on Bloomberg TV the other day. So here's the deal. Every $4,000 increase in the price of gold would give the Treasury General account $1 trillion free and clear. Put gold at $10,000, they get $2.5 trillion. And that's the number that Mike Maloney came up with by using M1, dividing it into the money supply. Guys like James Rickards said 24,000, and he has another metric for doing it at $24,000. I want to suspend everything we know about logic right now and just say at $24,000, it would give the Treasury General account $6 trillion free and clear to work down their debt. What it would really do is devalue the dollar. Now, I want people to think about this for a moment. If Trump really does want to reshore manufacturing, which I do believe is a noble cause and must be done, 60% of this country has no college education. AI is going to eviscerate and kneecap a lot of white-collar jobs. We need to put people to work. But we have $28 trillion coming due, you guys, in 3 years in treasuries that are maturing. By 2028, we owe $28 trillion. We have a $3 trillion a year spending deficit, right? So that's another 9. 28 and 9 is 37. We take in $5 trillion a year in tax revenue. What the hell do you do there? You're halfway there. Not even, you're a third of the way there to what you owe. So my feeling my feeling is they're going to destroy the value of the dollar to support the bond market in order to bring back manufacturing. Let me explain. I do believe they will revalue gold. I do. And when I did an interview with Judy Shelton, she as much told me so. Now, to Alasdair's point, she said first thing would need to be done would be to audit the gold. And she got very angry that their excuse was that it was logistically challenging and too expensive, as the gold is spread between the New York Fed, West Point Mint, the Denver Mint, and Fort Knox. She said, we're the United States, for God's sake, spend a few $1 million and audit the stuff already. So that she did say was important. I said, Judy, do you know that gold is held on every central bank balance sheet in the West in an account, you can't make it up, called the Gold Revaluation Account? That is the name of it on the balance sheet. It had been done in 33. It had been done in 72 and 73. Nixon devalued the dollar in 72, moved gold from 35 to 38, did it again in 73 from 38 to 42.22, where it stayed on the books till today. When Roosevelt confiscated gold in 33, he didn't revalue gold, he devalued the dollar, which revalued gold. He dropped the dollar by 40% and then revalued gold from $20 to $35 an ounce. Now, ask yourself this question. A, how do we bring back manufacturing? We cannot have the world manufacture our pharmaceuticals, our military equipment and components, our aircraft components, our microchips, everything. And this is the problem with being the world reserve currency. In fact, Vice President Vance even came out and said, and he wrote this on White House letterhead citing Triffin's dilemma, which says when you're the world reserve currency, you'll always have an imbalance in trade and your manufacturing gets hollowed out and sent abroad because we cannot give the world enough in the way of dollars, specifically, to just through trade in order for them to have enough liquidity to do what they need to do. So there will always be a exporting of US dollars, creation of dollars and exporting it to the world who sell their currency to buy ours, making ours expensive and theirs cheap. Therefore, we send the manufacturing to them in a much cheaper environment. They make all the world's stuff for us, the toys and the trinkets and all the stuff that we buy, and then they put their reserves into US treasuries. That's been the plan, right? And that has kept our asset prices high because of low interest rates. It's kept rates low and goods that we buy at Walmart and Target really cheap. It's been great for this country, except we went and screwed up a good thing by becoming the largest debtor nation on the planet. So Vance comes out and says, at this stage of the game, being the world reserve currency isn't such an honor and such a good thing for the US dollar because we have no manufacturing and it's going to only get worse. So he came out and acknowledged this, right? He acknowledges that Triffin's dilemma isn't such a good thing anymore. So maybe they don't want the world reserve currency. You think about the way we're tariffing our allies, Canada and Mexico and Japan and UK and Australia and the European Union. That's not how you treat your friends, especially after the last 4 years where our administration was literally too stupid to be stupid. It's not how you treat your buddies, right? No, you don't. You hug them and say, let's go, let's get stronger. No, you want to do business with us? It's a tariff. But what about the exorbitant privilege of the fact that we expect you to take dollars and put reserves in treasuries like the UK, who's become number 2, but we're still going to tariff you. Oh, so let me get this straight. We have to pay for everything in your currency, put the reserves in treasuries, and then you're going to tariff us? And you get this exorbitant privilege of low interest rates and high asset prices and cheap goods? Nuts to you. Well, maybe that's what we're trying to do. We don't want to be the world reserve currency anymore, but we want to bring back manufacturing because we have to, because either that or default or we hyperinflate. We can't grow our way out of this problem. So here's what I'm thinking, and this is why I think gold will be revalued, okay? So we got the stablecoin bill that's going to run the front end of the market, the short-term treasuries. You got the Treasury Secretary saying, yeah, we can get $2 trillion a year in this or more. You get all these corporations selling stablecoins, so you get enough money to run the front end of the government. The back end of the government, back end of the Treasury market, of the yield curve, will be, I believe, if you listen to what Judy said to me, she said, Andy, when I was on the transition team with Trump, and for those of you by now who don't know, Judy Shelton was Trump's nominee to run the Federal Reserve in 2016. She wasn't confirmed. Many think that she's in the running for this time when Powell's tenure expires. But She said he told me in no uncertain terms that he would issue gold-backed treasuries on July 4th, 2026, the 250th anniversary of the country. So the first step would be to reshore all the gold. We become wicked, massive importers of gold, right? Okay, so you reshore it. I said, Judy, why hasn't it been audited? Well, it's going to get audited, she said. I said, do you know it's held in the gold revaluation account? That's the name of it? Yes, Andy, actually I do. Do you think it'll be revalued, Judy? Yeah, I think there's a pretty good chance it will be, Andy. Now, this is all on my video. You can go listen to it. She's been saying this again lately, but why would you do that? Let's put it all together. So the stablecoin runs the front end. Now, if you revalue gold, let's just pick Jim Rickard's number at 24,000. You're talking about a 50, 60% devaluation of the US dollar, right? How do you pay $28 trillion in 3 years? You devalue the hell out of the currency, you inflate the crap out of it, you softly default on the US dollar. We tell the world, look, and look what Vance is saying, it's not a privilege anymore. Triffin's dilemma, we got to bring back our manufacturing. How can we do it if we were the world reserve? Well, maybe we don't want to be the world reserve. Maybe what we want to do is devalue the hell out of the dollar, revalue gold. Who benefits who? Well, it certainly benefits us with all the gold we've been bringing back. And maybe to Alasdair's point, all this gold we've been bringing back and not telling anyone about, do you think that the only gold coming back is coming back through COMEX? Hell no, it ain't. It's coming back through proxy banks and to JP Morgan's vault. And there's so much more gold coming back than is just being recorded on COMEX. I guarantee it. So we bring all this gold back, and then we devalue the hell out of the dollar and revalue gold to a level that not only benefits us, but it benefits all the central banks of the world who have been accumulating it hand over fist since 2016 and 17. Hand over fist. Look at the charts. They're the ones buying it all. They're not going to care. They're not going to be as pissed off when they've been buying it all. So the act of devaluing the dollar and revaluing gold so that, as Judy says, you can peg the back end of the curve to gold. What does that mean? That means zero interest rates. So the back end, you put a zero coupon bond redeemable in gold. The more stupid we are with monetary policy and the more irresponsible we are with fiscal responsibility, the higher the price of gold goes. It acts as the interest rate. It acts as the inflation hedge. You can't put 8, 10% interest rates on the long end of the bond, or stocks, bonds, real estate, the stock market, and the banks and the insurance companies go boom, just like that. You saw what happened when the long end went above 5%. The banks started to die. Put them at 8 or 9%. The real measure of inflation is so much higher than the BS, the BLS tells us. Look at the revisions on their unemployment the other day, where they said, yeah, the 300,000 or 400,000 jobs we said were created, it's only about 70,000. So they continue to disappoint us and lie to us about the CPI, where you talk about things like food, energy, and housing aren't in there, or the hedonics where the change it if steak is too expensive. We're not trusted anymore. None of this stuff works, right? So you peg the back end of the bond market, redeemability in gold, and you devalue the dollar. What does that enable us to do? Well, that enables us to bring home our manufacturing at zero interest rates and reestablish our manufacturing base with a very weak dollar and low interest rates allows us to sell our goods to the rest of the world. We already see through BRICS Pay and BRICS Bridge, all of these countries that are joined together with the BRICS their whole idea is a common settlement system outside the dollar. It's not a common BRICS currency. BRICS Bridge has already been connected to 11 Asian countries and 5 Middle Eastern countries, which is 38% of global GDP. And guess what just came out of Forbes magazine the other day? Those Asian countries, the countries in Southeast Asia that you know so well, Jesse, are now China's largest trading partner by far, 3 times what the United States is. And they're connected to BRICS Bridge, which settles in 7 seconds outside of SWIFT purview, can't be messed with by the SWIFT at a 98% reduction in fees. And we're now integrating it into the Belt Road Initiative, which is 75% of human population. It's not a common currency, it's a common settlement currency. So all of these countries are finding ways to settle outside the dollar, which was the world reserve currency. Well, how do we get people, A, to take our bonds, which still have the liquidity that nothing else does, and how do we reshore manufacturing at high interest rates? There's no way to, and a strong dollar. You can't. You devalue the dollar, you peg the back end at gold, which has zero interest rates. You bring back manufacturing, you devalue the hell out of the dollar and inflate the hell out of it to pay off the mountain of debt that you have no chance of paying off any other way without blowing up the system. And you hope to God that by bringing back the manufacturing, we are the engine of ingenuity. And when our backs are against the wall, the United States has done, I think, its best work. Go back through history and you'll see that. So in my mind, it's a Hail Mary. In my mind, there is no way to bring back manufacturing without destroying the entire system because of the interest rates. They have to go higher for people to take our debt because we're not trusted and we keep spending like drunken sailors. So if Judy is right, and they do peg the back end of the market to the bond market, to gold, to keep rates at zero, to bring back manufacturing, to sell our goods to the rest of the world, I think she's on to something because the stablecoin bill is the last piece of the puzzle, which runs the government on the very short end of the treasury. All of that liquidity is now, it's all synthetic, right? So hopefully this would work. I don't know how else that you bring back manufacturing, because if we don't, we're done. Ultimately, the next generation is dead in the water, in my opinion, when you have the wealthy at the top who are in financial services and in tech, and the rest of the country, 60% who doesn't have college education, and we don't make anything anymore. You're talking bad situation. So if there is any nobility in all of the things that Trump is trying to do, if he really is trying to bring back manufacturing, I don't know any other way to do this than what Judy is talking about, and the last piece being the stablecoin bill, which runs the front end. I think it's a shot. So yes, I do think they'll revalue gold higher than most people think possible. But what they're really doing by doing that is devaluing the dollar. And hey, you can't make it up. It's called the gold revaluation account. It's happened 3 times before. Why not do it again? So with all due respect to someone who I think is the smartest guy in this industry, I'll just take a different viewpoint. Who's to say I'm right? I don't know, but it makes sense to me.
Well, I love the different viewpoint. People agree far too often on this show. If I'm being honest, I can rarely get any sort of debate going on. I would like to move towards wrapping things up. But first, Alasdair, I'd just like your thoughts on the thesis that Andy has laid out. Does it seem like a realistic proposition in your view? Again, we're not going to go into some big debate, but I'm just curious how you see it.
It's not going to happen. It really is not going to happen. Apart from anything else, I think the numbers that are being bandied around, and it's not just Andy. Rickards and so on and so forth. If they were to refix the dollar to gold at that sort of level, I think 2 things immediately occur to mind. First of all, would I be able to exchange gold for my dollars for gold? The answer is probably
no,
not.
Backing the U.S. Treasury. No, it's backing the Treasury, not redeemability in the currency.
Yeah. Okay, that's the first thing. The second thing is we're talking about something like a 1,000% inflation kick on prices, all in one go. And I just can't see. Basically, you're saying that this is a deliberate act to destroy the economy. It's actually as simple as that, and I just don't see it. I can see them trying to put off the inevitable forever and ever and ever until finally they can't. But I think this sort of concept, and you see, the other thing is the first thing. Let's say the first step, right? We'll audit the Fed. Okay, that's fine. Immediately, you'll have all the other countries who have stored gold with the Federal Reserve Bank of New York saying, "Hey, how about us? Can we come and look at our gold?" You turn around and tell the Germans that they weren't allowed to inspect their property back in, 2012 or 13 or so. You're opening a can of worms as soon as you start talking about gold. This is the problem. And it's always for this reason that anyone who's gone into the Treasury, who was a gold bug or whatever before, going back to Alan Greenspan, the first lesson they learn is do not talk about gold. No comment. It's not on the agenda. For whatever reason. I suspect, and I think you probably suspect, Andy, that so much gold has disappeared from US Treasury vaults over the years. I mean, we're talking about 54 years of suppressing gold, trying to persuade everybody that it is no longer money. It's a pet rock. This is a very, very big hole, if you like, in national reserves, and nobody could possibly admit to it. So I'm not convinced. I just don't see it. And a deliberate act of hyperinflation. No, I think hyperinflation by accident, yes, but not something that is going to deliberately do it. Oh, and another third point, and I'll just leave it at that. We know that Russia and China have got more gold than anybody else, like huge quantities. This would enrich them hugely. I just don't see it.
Well, gentlemen, this has been a fantastic conversation. It's what I love about this show, getting different points of view. And the great thing is where we get to find out. Let's watch and see how things develop. And greatly appreciate you both sharing your knowledge with us today. Andy, tell us about Miles Franklin Precious Metals and where people can find it.
No, the best way to reach us would be send us an email at info@milesfranklin, request our price sheet, or reach out and ask any questions about what Alasdair and I just talked about, or anything you've ever heard me talk about, or any questions regarding precious metals, or just want the price sheet, which is going to be as competitive or more so than anyone in the country. And if you find prices cheaper, let us know. Typically, we're able to beat it. info@milesfranklin, and our new YouTube channel. Well, it's not really new. I've been doing it for a while, but we did bring on Michelle McCory, who we're very excited about, and she will be running shows 2-3 a week, and her and I will do one, and that's Miles Franklin Media on YouTube. So whether it be Miles Franklin Media on YouTube or info@milesfranklin to get our price sheet, or milesfranklin.com, you'll find us.
Great. I'll put all those links in the description below. Alasdair, tell us about the Macleod Finance Substack.
Yeah, the objective is basically to educate as many people as possible about what is happening to money, the difference between money and credit, the economic situation, government finances, geopolitics, all these things which people have been sort of ignoring, really. I mean, it's something which their very survival depends on knowing about. So really, it's all about education. That is what I attempt to do. And as you say, alastairmacleod.substack.com will find me.
Great. I will put that link in the description below as well. Gentlemen, it's always amazing speaking to both of you. Thank you so much for coming on the show.
Thank you, Jesse.
Thanks, Jesse. Thanks, Alasdair.
Thank you, Andy. It's lovely seeing you again.